Hello, everyone. I hope all is well. I hope all is well. Welcome back to the Money Level Show. It's your host, Daryl Thomas. Daryl Dominic is my rap name, which Dominic is my middle name, but Daryl Thomas is my first and last name. So I usually go by Daryl Thomas, but sometimes I get them mixed up when I think about the other aliases I have or whatnot. Just don't tell the government all my aliases though. So we got some stuff to get into today. I hope that you all are having a blessed day. Today we're going to get into a few things about Warren Buffett. You know, it says that he may be more bullish on oil, and forgive the misspelling of Warren Buffett's name, the great Warren Buffett's name. I'm gonna have to fix that somehow, but y'all know what it is. You know, we all make mistakes, right? So how y'all doing? Who's tuning in right now? Who's tuning in? Drop a comment. Who is tuning in right now? All right, fix his name. Cool. I knew it had two T's. So we had inflation data come out yesterday. I actually just released this interview with Brian Lundeen, and he talked about inflation staying above the Fed's target. He doesn't see the Fed getting inflation back down to 2%, which is their target. I agree with him on that, as long as the numbers aren't being changed consistently or whatnot, like they've refigured the algorithm or however they count it recently. So, and we've looked at shadow stats and we've seen the discrepancies, right? So so inflation came out, which it was, the market still rallied. It's like the market is always rallying on anything that may seems positive. Sometimes things are negative and the market still rallies because what the market does is it anticipates what's going to happen in the future. So even when the Fed hikes rates, you'll see the market rally, right? And you're like, oh, wait, that makes our debt more expensive. That makes our treasury debt more expensive. Our treasury is already struggling to pay the bills, so how is this interest rate hike more positive? Well, in the market's eyes, they look at, okay, well, the Fed is likely at the end of this cycle. They probably can't go too much higher. So then the Fed's going to pause. The Fed pauses, and then they will cut rates, and then the market's going to rally even more, right? So that's how the markets are looking at this. And so even when inflation data comes out, if inflation data is still low, then it's like, okay, well, the Fed is going to pivot at some point because the data is still showing like, hey, they're getting inflation under control. So just a little market 101 type stuff. So I'm gonna go over here. A few announcements. If you haven't joined the channel yet, be sure to join. Click the join button. It costs a cup of coffee a month. You can support the channel, get access to the interviews early. You can submit your questions, get top priority for me asking your questions to the guests that I have on. You also get shout outs in the video. So shout out to JT Coin Rings. Right now, he's my only member. So I need y'all to, come on. I know y'all spending $6.99 on something else you ain't supposed to be spending it on. So support your boy. Fix the camera a little bit. Other thing is that we do have the New Orleans Investment Conference coming up. So I'm going to go ahead and play the ad for that. And then we're going to get into the articles that we have today. So check out this article. Check out this ad. Hello, everyone. Sorry for the break in action, but I want to tell you about the link in my description below. This is to the New Orleans Investment Conference. This conference has been around for years and have brought many people out, such as Milton Friedman, Gerald Ford, Alan Greenspan, and Margaret Thatcher. This conference is put on by Brian Lundeen and his team. Brian is the CEO of Gold Newsletter. This year, they're going to have speakers such as Jim Rickards, George Gammon, Peter Schiff, Rick Rule, Danielle DiMartino Booth, Lynn Alden, and many others. Now, I encourage you to click the link in the description below. You can choose to attend the live event, which I will likely be at, as well as the event that is live streamed. You can support the channel by using my link below, so I encourage you to check that out. Now, let's get back to the interview. All right, we back. What's up, JT? Obviously the New Orleans Investment Conference coming up. Coming in person is just way better experience. So if you can make it out there, love to see you in person and just connect. It's just good to see people that are like-minded. Like many people in this space, like we can talk all day about this finance and the Fed and all these different things, right? But when you go out into the world and you go out to your job or just with the average person, like many people aren't having these conversations with you. So it's good just to be in an environment where you can have these conversations with other like-minded people that are super brilliant. So it's a good thing. So be sure to check it out if you can. All right. So I'm going to share screen. We've got a few viewers in here. Hey, y'all, be sure to drop a comment so I can acknowledge you. I like to acknowledge those who are supporting and showing up. All right. So first thing that we're going to look at is there's an article on Bloomberg that came out. It says Warren Buffett lifts fossil fuel bets. All right. So I've already been kind of studying a little bit, not studying. I wouldn't say studying, but I've read a few things about Warren Buffett and his bullishness on oil. It says energy is the cheapest sector in the S&P 500, yet generates the most cash. And Berkshire adds to stakes in Occidental LNG, which is liquid natural gas, and Japanese traders. All right. So Warren Buffett's multi-billion-dollar purchases of oil and gas investments early in the pandemic paid off when the sector cranked out record earnings in 2022. But instead of selling out for a huge profit this year, the Oracle of Omaha wants more. Berkshire Hathaway Inc. is using this year's dip in commodity prices to load up on some of Buffett's favorite oil and gas investments, showing that history's most famous investor sees opportunity in a sector disfavored due to its volatility and effects on climate. Earlier this month, Berkshire agreed to spend $3.3 billion to boost its stake in a liquefied natural gas export terminal in Maryland. This year, it has also increased its holding in Occidental Petroleum Corp by 15% and bought more stock in 5 Japanese commodity traders. Meanwhile, Berkshire's energy division is lobbying hard for a bill that would see Texas spend at least $10 billion on natural gas-fired power plants to back up its grid. All right, so you're looking at this is my first time reading this article too, so we're all reading it together. Energy is the cheapest section in the S&P 500 and makes the most cash. So you're looking at the price to earnings ratio, the cash flow per share. So the price to earnings for energy is 7.4, right? So 7.4, and then you have the rest of these like technology. I mean, it's 35.9, real estate 30. These are overvalued sectors. When you get to energy, it's the cheapest sector. Yep. So it's the cheapest sector. So I forgot how Mark explained it, but price to earnings is for every dollar of earnings. For every dollar of earnings, it depends. I forgot it. You got to go watch the interview. He broke it down for me, and I was like, I forgot. If somebody in the comments can remind me, please let me know. But price to earnings ratio, having a low one is the best thing to have. I'm still working on my valuations and all that stuff. I got some Rick Rule classrooms to watch and all these things. So, yep, I'm getting to it. But the cash flow per share, so that's 120.7. So this is way more than I mean, I think real estate is at the same, so it's at about the same, but it's overvalued. It's the price to earnings is overvalued. Actually, I know what it is. It's the earnings of the shares of the companies versus the price of the share. So every dollar of earnings, and it's like an equation with the price of the share. And so energy stocks are cheap, still cheap, and relative to their earnings ratio. So they earn a lot, which means that they're cash flowing right now. You know, as you can see, the cash flow per share is 120, but the stocks are cheap compared to how much cash flow they're getting. Because if you look at the real estate, they're at a 37.2 price to earnings ratio versus energy at a 7.4. So energy is cheap, especially even the technology. Technology gets a 116 point zero cash flow to per share, and then but it's at a 35.9 PE ratio. So energy is the cheapest and it gets the most cash. So it makes sense. So it says on one level, it's classic bargain hunting by Buffett and Berkshire Vice Chairman Charlie Munger. Persistent concerns over the sector's environmental, social, and governance performance, poor pre-pandemic returns, and the risk of declining demand for fossil fuels in the decades ahead have soured many investors on the industry. Energy trades at the lowest price to earnings valuation of any sector in the S&P 500 index, according to data compiled by Bloomberg, but it also generates the most cash flow per share. Let's see. People are missing the economics that Buffett and Munger are looking at, said Cole Smead, Chief Executive Officer of Smead Capital Management, which manages $5.4 billion, including Berkshire and Occidental shares. The returns on capital in coal, oil, and gas are off the charts compared to with other sectors. And with ESG, you can buy them cheaper than you otherwise would. So it says a nuanced bet, but Buffett's oil fossil fuel bet isn't without nuances. While Berkshire remains the third largest shareholder in Chevron, it cut its stake by about 21% in the first quarter. Occidental, Clove Point LNG, and Japan's trading giants all have unique assets that will play a key role in powering the world, no matter what path the energy transition takes, if it occurs at all. All right, we got some people watching. What's up, y'all? Be sure to drop a comment, say what's up. Even Berkshire, seemingly straightforward investments in oil have their subledies. I don't know if I butchered that word. Take Occidental. Buffett invested $10 billion to help Occidental beat Chevron in the bidding war for the Anadarko Petroleum Corp in 2019, and the company now owns an area the size of Jamaica in the world's biggest and lowest cost shale oil field. All right. At this year's annual meeting, Buffett stressed how shale is different from conventional crude sources in Russia and in the Middle East. Shale wells, which make up the majority of U.S. production, can be brought on quickly and have short lifespans, making operators more flexible in responding to oil demand and prices. In the United States, we're lucky to have the ability to produce the kind of oil we've got from shale, but it's not a long-term source like you might think by watching movies, he said, dubbing it short-lived oil. Buffett also said both extremes in the climate debate have gotten ridiculous in their arguments. We will make rational decisions, he said. We do not think it's un-American to be producing oil. All right, so these are the profits from Berkshire Hathaway's energy profits. So in 2022, they reached almost $4 billion in profit. Clove Point LNG provides another example of nuanced energy play. The facility buys gas from a nearby Marcellus shale and chills it into a liquid before shipping it around the world. It also has the rare ability to import gas, something rival plants on the Gulf Coast cannot do. Global LNG demand has risen substantially in recent years as Europe replaces Russian gas. Asia uses it to generate more power for its growing economies, and countries seek cleaner alternatives to coal. All right, so And they trying to get me to subscribe hard. All right. So we see that Buffett is bullish on oil. He's bullish on oil. And this is maybe another play too. I think Daniel mentioned this, one of my subscribers. He mentioned the tankers, the oil tankers. And this is a part of the play is where they have to ship the liquid natural gas around the world. So those are what tankers are needed for, to ship energy around the world. Unless you have huge pipelines like Russia did. So Buffett's bullish. So we're going to go ahead and look at Warren Buffett's Berkshire Hathaway's holdings. And we're going to see just how bullish they are in their portfolio. And this may not be the updated one. It should be, but we'll see. All right. Yeah, I think it's updated. So we see here their biggest position is in Apple. They got 45.3%. That's a lot. And then they have a big significant position in Bank of America. Buffett loves Bank of America. As you can see, when you get to Chevron, they have 5.5% in their portfolio, which is a decent size compared to, Apple having 45. This isn't much percentage left. It's only 55 left. So that takes up 5% of that, 5.5% of that. They have a 6.7 stake in the percentage stake in the company. And then they also have Occidental, which is down here. They have a 4% stake in Occidental, and they own a quarter of the business. Yep. So they own a quarter of the business. Let's see if they may got some other ones in here. Let's see. They got defense, but it isn't that much. So they do have this energy, whatever, Vitesse Energy Inc. I never heard of that, but yeah. So they got a significant size of energy in their portfolio, and we're gonna go look at the S&P 500. So I bring up the S&P because during the energy bull markets, more fund managers, more retirement funds invest in energy. So we're still waiting on the huge influx of capital to flood into the energy markets for the share prices to really skyrocket, right? That goes for oil, uranium, gold, all these things, right? And so we're going to go look at the S&P 500 in their makeup because I think it'll be important to check that out. Let's see. All right. Pull that up for y'all. Boom. All right, we're just looking at the SPY ETF right now. And I'm glad I almost played an option on that, and it came right back down. I'm glad I stayed away from that. All right, so here we go. All right, so we're looking at the sector weightings right here. So when you get down to energy only makes up 4.28% of the S&P 500 of the SPY ETF. Technology is at 28.78%, which is a huge significant part of that. So when you see energy is very underweighted compared to, looking at the price to earnings, right? Energy stocks are cheap and they're printing cash, but they only make up a certain amount in the S&P. They also pay really good dividends. Anywhere from 5 to I've seen 9%, 10%. So they pay solid dividends, and energy is only making up 4.28% of the S&P 500. They're still on the technology bet, but we're here on this commodities bet. So we're going to go look at the history of the S&P 500 industries. So this is a pretty interesting article I found because I wanted to look at, okay, If S&P is only has 4% of energy, what is it like during the previous bull markets? So you can see this is a cooler graphic, but it doesn't show what I needed, what I'm looking for. So you can go down here and you can see changes in the S&P 500 index in the 1970s. So these are the 70s here. So you got this is the most removed sector from the S&P. This is the most added sector. All right. So these are the 70s. I'm surprised they didn't put oil in the 70s, which is interesting because we had the embargo and all of that. But I think we may have been producing more then. Let's see. So then you get to the 80s. 80s, you got a lot of industrials. I mean, even energy and industrials were removed in 83. So we're not seeing anything there. All right. Get to the 90s. The 90s, they're adding more financials, communication services, and such, information technology. I mean, think about this. This is the dot-com bubble, right? So they're adding these tech stocks. You had healthcare and consumer goods and such, which that was a good end of that decade from the 80s to the 90s. And then you get to the 2000s. IT stocks, they remove energy and industrials, energy and financials. They removed them, but they added tech. This is during the dot-com bubble. Dot-com bubble popped. They added healthcare and financials, which this is a good play here. It's a defensive play. And then you get to 2005, they add consumer, discretionary, and energy. All right. So let's go look at a chart, crude oil chart. Let's see how much this how much this. Okay, what the heck? All right, here we go. I'm always finding freaking new charts, y'all. So sometimes I need to just find one place that I'm looking for, one chart that I'm looking for, and just leave it there versus, trying to look up on Google at all these different sites. So I need to bookmark certain sites. All right. So we're going to look back at this tab. All right. So here we go. This is the chart of oil. So the S&P, we see that they start adding energy and consumer around 2005. They added again in 2008, energy and industrials, right? So let's look at the chart. How does this relate to the charts? All right. So you got 2004. This is crude oil. Then you're getting this crude oil is moving up, right? And then it moves up again. So the S&P added crude oil in 2005 because we're in the energy bull market. They then added more energy in 2008, right? February 2008. And then it topped out at what? 100 and let's see, 100 and $42. So the S&P was adding more energy during that time. So let's go back. Let's look back at the dates. All right. So then you get to 2010. They add more energy. 2010. All right. Let's go look at the chart. 2010. So 2008. And then you had the blow off top. You had the global financial crisis. Obviously recession, demand is reduced. So, the price of oil collapsed. But there was still a supply issue and we were still in a energy bull market, right? So then, they added in 2010, they added more oil. So they added here, around here somewhere. Then oil goes up again, right? And then as you can see here, let's see over here, they sold off energy in 2012. and then they sold it off more in 2014. They sold more of it 2015, and they sold more in 2018. So that relates to all the charts we're seeing, right? So 2012, they sold off, it skyrocketed again, boom, came down, went up again. 2012, they sell off some energy. Then they get to 2014, sell off some more energy. Energy plummets, right? And then they keep selling. And so right now, they haven't been adding energy back, as much as they were adding back during this bull market. So that is an important thing to note, right? So the S&P, one of the biggest funds. So you have all the hedge fund managers, you have all the freaking, obviously retirement 401ks and such. They all, were probably in energy at that time. And we have yet to see that yet. I'll say yet. Let's see. Ask in the first clips. I think oil will weaken before it strengthens. Afterwards, though, it will remain high for quite some time, but we have a while before then. Market will drop first, perhaps. Just my belief. No, I definitely agree with you. I appreciate you for chiming in too. I definitely agree with you because I've been interviewing the guests. Hey, are we going to have recession? What does recession do? It reduces demand and oil falls usually. My only only caveat this time is that we haven't invested enough, and supply is still tight in some areas, and such. And so, and then you still have the narrative, the ESG narrative, and everything. There's still a lot of pressure on the oil companies, and they aren't investing much profits back into drilling more and producing more. And they had this whole back and forth with Biden last year about it. So, it's kind of, it's like, okay, well, we could see an initial shock though, an initial shock. If there's a recession, an initial shock in demand, I could definitely see the price coming down. However, when we come out of that recession or whatever, right? They're saying we're not going to have it, which really makes me think that we are going to have it, or we're already kind of in the kind of this weird space where we've had a big downturn last year. And but we're going to start, producing more. There's going to be more investment in the space. They're going to try to build infrastructure. They're going to try to, push for the green energy, which is going to take more oil to get the materials for the green energy and stuff. And so, we're like, when we come out of whatever we're about to go through, they're going to need energy. They're going to need all these materials that we're loading up on. They're going to need uranium. They're going to need lithium. They're going to need silver. All these different metals and such, these rare earths and stuff. Like, they're going to need all this stuff, and we're loading up on them early. Like, the stocks are still cheap. Even the gold miners, like, I'm hearing from multiple professionals. Even Brian Lundin came on I released a video early this morning, but I interviewed him yesterday. He said that the gold miners are very, very cheap, so I think as we come out of a recession or whatnot, we are going to see commodities just run, and then eventually everybody's going to hop on the train, right? You're going to have the S&P add more energy. You're going to have retirement funds add more energy, and people are going to be looking at these energy stocks. And then when they do that, that's when we're in position to, start trimming, some of the bag. I guess it just depends on your investment strategy. For me, I'm going to be selling on the way to the top. I am not going to be trying to time the top or the bottom. Well, the thing is, it depends on what it is, right? So I would say with uranium, I will likely be selling on the way to the top. I'm not going to try to time the top or anything like that. But right now I'm focusing on accumulating a really significant position size before they start running. So that's what I'm looking forward to with uranium. But uranium also isn't paying dividends, right? versus like oil. I can hold oil while the share prices are going up and collect even a pricier dividend, a more healthy, hefty dividend on the prices going up. So that's kind of a little different, right? So I may be trimming uranium on the way to the top. Um, and then but the oil stocks, I may hold on to more oil and transporters and such. And so said when gold rips, I don't know anything about uranium, oil stocks, dividends, or sweet. Yep. Yeah. So uranium is I'm actually releasing an interview tomorrow with Justin Hume from Uranium Insider. That is nuclear energy. So nuclear energy is we believe is the future. Um, and I mean, pretty much the world uses about 200 million pounds of uranium per year, or I think it's pounds per year. And right now, since the pandemic, we've only been producing about 155 million pounds. And so we're operating at a deficit. So it's a supply demand issue. But then you also have it's the cleanest form of energy out there. Um, it's zero carbon emission free, and that's where a lot of the nations are trying to head towards. And so many of the professionals in this space are betting on uranium based off the supply demand and just the overall investment thesis. Which I mean, uranium had a huge run in the early 2000s. I mean, if we look at a uranium chart, you know, huge run. All right, we're gonna look at a uranium historical chart. Cool. I'm about to bookmark this site. Trading Economics. Shout out to Trading Economics. They got all the charts ready on commodities. I don't have to go through all this stuff, you know, to find what I need. So shout out to Trading Economics. I'm gonna book their site. So this is a uranium price chart. So I'm gonna go ahead and change the date. Let's go to what? 1995, 0807. I'm just throwing a random date. So this was uranium. It was just dead for a long time. And then even Rick Rule, like he said that, the thesis at that time was so strong that the price had to go up. And then, sure enough, the price went up. 2007, this was all energy. This was the time oil was going up and stuff too. Obviously, uranium it was a lot more volatile, took a huge haircut, and then bounced back a little bit in 2011, and then went down significantly. But I mean, this is where Rick Rule tells that story about him investing in Paladin stock. And Paladin stock was 10 cents at the time. He was managing people's money. He invested in Paladin, 10 cents, goes down to 1 cent. And Rick Rule just kept looking at the arithmetic and the math. And he's like, this has to go higher. And so him and the shareholders, they bought more. Sure enough, that stock went to $10. He said he didn't hold it to $10. He sold it on the way up, which I would have too, But imagine, if one penny, he had 1 penny and it just magically turned to $10. That's insane. That's an insane amount of cash. So right now, uranium stocks are very cheap, and we believe that we're out of this long term, bear market here. I mean, it's been on a bear market since freaking, had a little spike here, but it's just been in a bear market ever since. And so now the investment thesis is looking really good, and we believe that we're in the next bull market. So that's part of uranium. Also, I mean, other factors, enriched uranium, Russia produces a significant amount of that. And so now you have many nations are like, okay, we need to up our nuclear fleet. And so Yeah, so there's many nations that are on board. Japan just reactivated theirs. I mean, obviously here, I mean, you had Japan had the Fukushima, the crisis with the earthquake and the tsunamis in the nuclear reactor, and so it just plummeted ever since then. But the technology's improved a lot, and so and you can and they're making technology where you can power a house with just like a small like modular reactor of nuclear energy, and so it's very clean and efficient, and it has the least amount of deaths per terawatt hour, versus it has less amount of deaths than coal for sure, oil, natural gas, and even has less amount of deaths than wind and solar. And so that's my bad. I just went through the whole. I went through partial of the uranium thesis, but I'm glad that you mentioned that. So yeah, I'm gonna check out Karora Resources, K92 Mining. That seems like a cool company. I'm gonna check it out. So yeah, I wanted to leave you all with that. I am going to be dropping a interview with Justin Hume probably tomorrow or Saturday. I do have some other interviews coming up. I do have Neil Howe from the author of The Fourth Turning. He is going to be coming on in about a couple of weeks, um, which I have a lot of questions to ask him, and hopefully we'll see how much we can get through. But yeah, I mean, just thinking about the average folks that are out here trying to make it. I really have some questions about like what does this look like historically for us, when we've had significant crises in this country, and and how can we prepare for that? So that's going to be a huge one. Best New York Times best-selling author. So yeah, be sure to check out his book, The Fourth Turning, and his new book is The Fourth Turning is Here. That's the one he just released. I'm gonna start reading it, but it is 500 and something pages, so I doubt I'm gonna get the whole book done by then, but we'll see. So that's another interview coming up. Rick Rule's coming up at the end of the month, as well as Adrian Day. And then next month, I still have Nomi Prince coming on. So we got some good, solid candidates. I mean, not candidates, solid professionals coming on the show. Appreciate y'all support and tuning in with me as the channel is continuously growing. Yeah, thanks. I appreciate it a lot. It takes a lot of practice. I'm from the South, man. I talk with slang and slurs and things like that. And so, it's been stretching me for sure doing these interviews with these professionals. But yeah, no, yeah, I appreciate you dropping a name. Because yeah, it's something we could look into. So you all have a blessed night. I'm gonna do a video. I'm actually gonna do a video. I just signed up. I was kind of trying to figure out how I can access some stocks that were on the Toronto Stock Exchange, and I also always wanted to buy Kazatomprom, which is on the London Stock Exchange, which that's one of Rick's favorite uranium stocks. So I did sign up for an interactive broker, and I was able uh, to buy stocks on different stock exchanges, so the Toronto and such, and I know that I didn't know how to do it. I don't know if all of y'all know how to do that stuff, but I didn't know how to do it. So, and there's issues with the OTC market with liquidity and things of that nature. So I wanted to buy from the Toronto Stock Exchange, some of the companies at the Rural Symposium. So I was able to sign up on Interactive Brokers. And so I want to walk you all through that process if you're interested in buying some of these companies that are on different stock exchanges. And there's this whole process where you have to put money in, and then when you put money in, you have to convert it into the currency that country uses, and then you can buy the shares of the company. So that's going to be a video that I'm going to release probably sometime this weekend. So all right, y'all doing all right? I think I'm gonna go to the gym for the last hour. They close in an hour. So y'all take care of your health, your wealth, your mental health, emotional health, spiritual health, financial health, physical health, all of that. Take care of all of that. All right. Y'all be well and y'all take care.